Still not great, is it? Okay. Okay, welcome everyone. So this is week 9, CFA. Last week we did pretty much a little bit more than half of the second lecture on valuation, and we said we were going to continue on that just today. So before we do that, I will just ask you a couple of questions. Oh, we got the music back, that's good. So one of the things that we discussed last week is price earnings. We discussed price earnings and different interpretations on how it relates to return, to times paid, and how these price earnings are related to a forward-looking price divided by a backward-looking earnings. So this is what the questions are going to be about today. Okay. Just wait for a couple more. Okay. Wow. So just before hitting go, I said, so price earnings is looking at a forward-looking price divided by a backward-looking earnings. Who's that? Put your hand up. Who's the one with the green answer? Yeah? All right. You deserve a team time. I haven't seen this one before, having just one person with points. All right. Yeah, so there's no negative price earnings. One of the things you've seen or you will see in your tutorials this week is that there's there's a question about two mining companies and two financial services companies, and the two mining companies had negative earnings. If a company has negative earnings, you wouldn't calculate the price earnings, right? Because it doesn't make economic sense to have negative price earnings, right? Because it would be, can someone tell me what would be the economic interpretation of having a negative price earnings? So if a positive price earnings is how many dollars an investor is willing to pay for each dollar of earnings in a company, what would be a negative price earnings be telling us? It would be something like, yeah, you want to say, it would be like saying how much an investor will expect the company to pay him, right? So it doesn't make economic sense. So we don't calculate negative price earnings. So as soon as we have negative earnings, there's no price earnings we can calculate. Price earnings will always be positive. Yeah, so so one of the things we have to adjust when we calculate price earnings is make sure that any non-recurring items are not included in the earnings. You only want to include earnings that are persistent, right, and related to the BAU. Yeah, so this is what we did when we did 1 divided by the price earnings. Right? When we do earnings divided by price, that is a proxy for expected return. And we also demonstrated last week how we can turn the price earnings into a perpetuity. Yep. Cool. That's a very harsh statement. Yeah, so same case, just a different way of looking at the same thing. If earnings are negative, what we get from price earnings is not meaningful. We've got a winner. Who's the winner? Hands up. All right. So you want we've got 2 options for today. So regular Tim Tams or Chill Me. One from Messina. So original or the ones for the fridge? Original? All right. Well done. Someone else will have to get the ones for the freezer. Okay, so we left halfway through the presentation last week, and we discussed the perpetuity, and we're going to take it from there in slide 25. I should say 27. So what we've been doing in our valuation lectures is discounted cash flow, residual income, and now we're working on multiples. In multiples, we looked at market-to-book ratio and price earnings. We did a discussion on price earnings, how we can relate that to a perpetuity, what it means, what kind of earnings we need to use, what sort of corrections we should make. We will do a few other, we will discuss a few other things around price earnings. One of them is when we thought about the perpetuity, we were thinking about or discussing a perpetuity without growth. But by the same token, we can think about price earnings as a perpetuity with growth. So if you're looking at a company and you want to get, so what we are getting when we do 1 divided by price earnings is not necessarily the expected rate of return, but is the expected rate of return net of the expected growth, which is what you see in the bottom bullet in this slide 28. So price earnings of 10 could be associated with a company that has an expected rate of return net of expected long-term growth of 10%. And that could be a company that has an expected return of 12 with an expected growth of 2, or any other combination that gets you to 10%. All right? And this takes us to the price earnings growth approach, which is just a slight variation of the price earnings, where, and you have in the tutorial this week, you had a question around this, where you're dividing the price earnings ratio by the annual growth rate in earnings expected for that company. So this is a normalization or a correction or an adjustment that we're doing on the price earnings to impact the expected growth on earnings. And this could be a good way of bringing a little bit more information when we're comparing a number of companies using price earnings, where we are not only using the price, that is a valuation which is forward-looking, looking on expected cash flow generation by the business, divided by a past earnings, but by introducing the expected growth on earnings, we are adjusting that, right? So this is a way of fixing the problem of using past earnings. So instead of dividing the price by past earnings, we are adjusting for a better measure of earnings. We can do this if we have information about what the expected growth rate for next year's earnings is for the company. Otherwise, we wouldn't be able to do it. So let's just look at an example. We have a company that has a price earnings ratio of 50 and an expected growth in earnings of 40%. It's pretty big, both the price earnings and the growth rate. That gives us a price earnings growth ratio of 1.25. If the price earnings of the company was only 30 divided by the growth of 40, that will give us a price earnings growth ratio of 0.75. So this price earnings growth ratio, we would want it to be close to 1. Or below 1. If this price earnings growth ratio is over 1, what we're saying is that that given historical earnings and growth prospects, the shares of this company are overpriced. Whereas if this is 1, what we are saying is that, and this is only a proxy, because as you see in the bottom bullet in slide 30, what we are using is expected earnings for the next 3 to 5 years. So it's not necessarily something that is as formally accurate as what you would do with a discounted cash flow, right? This is a proxy, and this proxy is telling us whether current prices are under or overpricing past earnings and future growth. PEG equals 1, fairly valued, over 1, overvalued, under 1, undervalued. So if you're thinking about buying, having a price, a PEG under 1 could be good news. Because you're saying, on average, the market is thinking this company is growing at 40%, but the current price earnings is only, is not getting that into prices. So it's probably a good time to buy because the price should go up as the market realizes that the company's growth prospects are better than what the current price is telling us. Yeah, so this is the question you have in this week's tutorial about PEG. One further adjustment that you can do to the price earnings is not only using the earnings, but also adjust for the dividend payout. So this is a company with, so this we're doing on top of the price earning, the PEG, right? So the PEG, we would do price earnings divided by the growth rate. And when we do the price earnings growth yield ratio, we're doing the price earnings divided by the sum of the expected growth rate plus the dividend yield. So this is a company that is growing at 40%. And has an 8% dividend yield. So we are dividing the price earnings by 48. Definitely the main issue with using price earnings ratio is what happens with transitory earnings, earnings that are not persistent and that are not going to be repeated in the future. So every time we look at price earnings, it definitely needs to look, I don't know if you remember with Coca-Cola when we did the analysis, there were some expenses that were related to some restructuring. So if we let that restructuring get in our earnings for the price earnings, that would not be a good way of calculating price earnings, because that restructuring only happened once, and we're assuming that that is part of the persistent earnings or losses. So you're going to find the price earnings calculated for you. I would strongly recommend to look at the earnings, look at how those earnings are calculated, and to make sure that everything included in there is persistent and is part of the core earnings of the business. Those are the main things you need to think when you use price earnings. I'm skipping a few of these slides, 36 and 37, that discuss different items that are included or excluded of core earnings. Those are things that you can go by yourselves and have a look at. I just wanted to stop here to look at some empirical findings from price earnings ratios. So 50 to 70% of the variability in price earnings is explained by risk and growth. And that makes sense, right? Risk and growth are the two main things when you're thinking about relating earnings and price. Because we're relating past earnings with a forward-looking price. That forward-looking price is forward-looking because it's expected earnings or cash flows in the future, right? Discounted at a discount rate. So definitely, the relationship between price and earnings will be determined by how much earnings in the future grow compared to past earnings. And it would also depend on how risky those earnings are. Because the higher the risk, the higher the discount rate, right? So let me just go with risk first. The higher the risk, the higher the expected discount rate, the lower the present value of future cash flows, right? So riskier companies will tend to have lower price earnings, right? All other things equal. Whereas growth, the higher the growth, the higher the future earnings compared to past earnings. So the higher the growth, the higher the price earnings. And these things tend to combine in real life. So you're going to have some companies with higher growth rates and less risky, and some other ones with higher risk and more or less growth. But those two variables explain quite a bit of the variability in price earnings. Price earnings also predict future earnings growth. But in the long run, there's a mean reversion. The fact that price earnings predicts future earnings growth makes it reasonable that we calculate the price earnings growth ratio, right? Because we know that those price earnings have some information about growth. So what do we know about market to book value and price earnings? There's this study by Penman getting some intuition about those two. The first one is pretty straightforward, and we discussed this when we saw market to book value. We would expect market to book value to be 1 when the company is not expected to make any abnormal earnings, right? So the residual income equals 0. Your market value will be the same as your book value. So that is something that we know from our discussion of market to book values. And the other thing is that in the long run, the 1 divided by the price earnings should be a good proxy for the expected rate of return. Because in the long run, growth rates go down, and the no growth perpetuity should be a good proxy for the company's economics. And the final point that we are getting from slide 38 is that price earnings should be high when current return on capital invested or capital employed is lower than the long run. And that makes sense because this is talking about current and future profitability, right? If future profitability is higher than current profitability, we should have a higher price earnings. Because in the price earnings, we're using past earnings, right? So what this is telling us is our price is getting all that higher profitability in the future and is dividing against some earnings which are current for the last 12 months, which are less profitable than the ones in the future. So this is again going back to the very top point in this slide 38, which is growth and risk explain most of the variability in price earnings. Where can we use price earnings and market to book values? Well, we can definitely use it to value private firms. I wouldn't use it to value them directly, but I would definitely, after doing my discounted cash flow valuation, I would get information from companies in the same industry and use those multiples to double check my valuation makes sense. We would definitely need to make adjustments, and one of the main adjustments we have to make is for liquidity. All things equal, would you expect the same company to be worth more if it's public or private? If the fundamentals of the business are the same, would you expect a public company to be more or less expensive than a private company? Yeah? No idea? There's a liquidity issue with private companies. It's a lot harder to get rid of them, right? So in terms of risk as an investor, you're in a worse position if you're invested in a private company than if you're invested in a public company. It's a lot less expensive to sell shares of a public company than selling shares of a private company. So that should have a positive impact on the pricing and in the value of a public company. All right. So we've looked at 3 valuation cases using cash flows, using earnings, and using ratios or market-based valuations. My preference in the answer to that question, which one is better, they all have good and bad things. Definitely I would stick to the first 2 as your main tool. My preference is towards DCF, discounted cash flows, but that is only my preference. I would definitely use market-based valuation, as I said before, as a control for my own discounted cash flow or residual income valuation. It's really, and this is very good for the assignments. When you're not, you can discuss your valuation using a point, saying this is the value, because you have to use one value, right? Say this is this asset is under or overvalued compared to this number. But it's good to have a range of values that you consider the company could take. Because valuing a company is a shot in the dark in many respects. Right? You're going forward 20 years, doing a forecast, using a discount rate and getting a number. When you use your market-based multiples, that gives you a good idea. You can have a top and a bottom range for your pricing. And I would be comfortable if my valuation sits within those top and bottom margins, right? Because that means you're not too far off from what the market on average thinks about companies in this industry. And that is what the last sentence in slide 42 refers to. Why instead of getting just 1 point, why not getting a range? And that range you can get from the multiples, but you can also get from a distribution of values from your DCF or residual income. All right, so that is it for last week's presentation. I'm going to ask you just a couple more questions, and then we're going to move forward to week 9. Okay. Remember, if price earnings growth is below 1, then the asset is undervalued. So we could buy those shares if we believe on the growth rate, on the expected growth rate. And we would never go with companies with ratios over 1. Peggy. We got Peggy, that's good. Between 50 and 70%. Yes, the paradox is basically if we assume all the information out there is already in prices, there's no point for us to look for undervalued or overvalued assets. This is a typical exam question. We're missing a few, right? Which one? Oh, that's... So did we miss anyone? Like any really good one? Double coat? Yeah. Those are my favorite. All right. Who's the winner? All right. So you're going to be my guest trying the iced coffee ones. You have to tell me how good they are, because I haven't tried them. Thank you. All right. So the idea for today is to look at how reliable accounting numbers are and what sort of adjustments we would need to make and what things we should be looking at in order to make sure that the information we use is as reliable as possible. So two things we're doing today is looking at how to spot information that is not extremely reliable and looking at ways to fix that problem. So the reason why we can't use information coming from financial statements as they are provided is mainly because the data there is following accounting rules and not necessarily economic effects. So we just need to be aware of situations when accounting rules could be distorting the actual economic effects. And it's also because when we're looking at financial statements, information in current financial statements may not, and usually don't, portray what the performance of the company is going to be in the future. And the other reason, which is not in slide number 4, is because we know that management has incentives to manipulate earnings. And that is something that we have to be aware of when we're looking at financial statements. So what do we mean by accounting quality when we're looking at a balance sheet? So the key here is looking at a balance sheet that reflects what the firm actually is and what the firm actually owns. The key here is that they're representative of what the real firm is. And that point discussing, this is not about conservatism but representativeness, is because you just want to make sure that whatever you're putting in your balance sheet is actually what the company owns. Many situations with companies putting things off balance sheets really distort the real economics of the firm. So we just need to make sure that the real firm is what we're looking at. So a high quality balance sheet will show what the company actually owns and operates. in looking at those financial statements, we have to be very careful and question ourselves and the company, if we have access to them, when we see that there's assets or liabilities that are supposed to be there but we don't see them, or that should be larger than what they look in the financial statements. So they should be a fair portrayal of what the firm is. Assessing the quality of the balance sheet is a lot easier when you know about the industry, because you have a better understanding of the economics of the industry. It's a lot harder when you don't know much about firms operating in that landscape. On the income statement side, we would say that an income statement is high quality if we see that the operating performance is reflected in the income statement, and that all revenues and costs have been reflected. And we are thinking about or looking at a company with a lower quality when we see that some of the earnings, some of the revenues recorded are not necessarily earnings or revenues that will be made by the company. Or if we find out that some expenses are missing or have not been reported. Sometimes playing across periods is something that happens, backdating things so that current earnings look better, or making things look like they're occurring faster than they actually are. So those are situations in which we need to ask ourselves whether this income statement is really telling us all we need to know. Obviously, any financial analysis or valuation process is, in a way, a black box in which you get information and you get an output, right? As in any system of such characteristics, if you don't get really good information on the inside, in the input, the output of your work is not going to be very good. So it's quite important. I can't stress enough how important it is to make sure that you understand that the information you're dealing with is of good quality. And you will find valuations making lots of caveats on this is the outcome we reached after using all this information and making our best efforts in double-checking everything, but there's things that the company wouldn't provide or wouldn't answer to all these questions that we have to assess the reliability of the accounting information. The notes are key. The notes to the financial statements are key to understanding many of the information bits in the financial statements, including changes in accounting principles and different ways of measuring things. So those notes, we would also expect us to help us understand what's happening and what's the quality of the financial statements we're looking at. I didn't do that, sorry. So what are the concerns about accounting quality? Well, when you look at financial statements and they don't seem to be telling all there is to tell, it's quite telling that the company has things to hide. So when you start looking at these quality issues, you definitely have some sort of concern about how trustworthy people presenting you these financial statements are, and that will definitely have an impact on your valuation of the company. There's 4 potential levels at which we can tell how informative earnings are. And this goes beyond what is required by accounting principles. But you will have firms that give you earnings that tell you about current earnings, but it would also give you information about how sustainable these earnings are into the future. And that is a good level of quality for the informativeness of earnings. Another level is having, yes, good and reliable information about current earnings, but we don't have information about how sustainable those earnings are, right? It's very hard to determine what percentage of current earnings are really persistent, right? And what percentage is just what's happening this year or in the past 3 years. There's a lower level of information in earnings where we have information about current earnings but no information whatsoever about what's expected to happen in the future, right? So the difference here is you will still have your income statement with your earnings, but the discussion of the management in the notes will be in the higher levels, a lot more detailed about what this means and what this means in terms of what's happening in the future. And at the lowest possible level here is when the information in earnings is not even telling us what's happening in the current period. And the reason for that being the lowest possible level is because there are concerns there that the company is actually hiding what happened. And there's a good reason to think that there could be some earnings manipulation in that situation. So how do we improve the quality of the earnings we're using? What sort of things we have to do? Well, we have to do several adjustments for different things. So we're going to be looking at all those different adjustments and make a quick mention to each of them. What sort of impact we will expect to have of these adjustments to have on stock prices? It'll depend on, let me give you this picture. We're looking at earnings for a company and we're making adjustments to those earnings. And we're asking what sort of impact will this have on the price of the stock of this company. This will depend on whether our adjustments are in line with what everyone else in the market is doing, right? So if our adjustments are not in line with everyone's expectations, we're going to have variances on the stock price of our valuation compared to other analysts in the market. Number one adjustment we want to make, and I mentioned this before, is remove any non-persistent items, right? And I mentioned the case of Coca-Cola Amatil with the restructuring costs. These restructuring costs are not persistent. It's not something that we will see year on year. So we will definitely adjust for them by excluding them from the earnings we're using for our analysis. And the thing is, if we remove those non-persistent items, we will have to make adjustments in historical financial statements so that when we calculate ratios, we are calculating those ratios in a consistent way, right? Because all the time when we're looking at our historical financials, we're looking back to get information that we will use for our forecasts. So if we are cleaning up things or making adjustments, we just need to make sure that those adjustments are consistent. That came a little bit early, but I will skip it. Adjust for discontinued operations. We are valuing a company that had a series of operations that no longer are active, either because they were sold or discontinued by themselves. We definitely need to make adjustments for that, and we will adjust historically so that they don't impact the ratios, because we will have that same impact in the future. So as you see in slide 16, all those adjustments will have to go, if we're using 3 years of history, we will have to go back and make those adjustments so that each and every one of our ratios is adjusted for these discontinued operations. We will also adjust any extraordinary items. And even though there's different definitions of what extraordinary items are, and here we have principles for the US and Australia, and even though they're told in different ways, they pretty much look at the similar categories. They're unusual, infrequent, and material. So in Australia, that is, as in, it is a one-off, so it's infrequent, it's large and unusual in nature, that is material and infrequent, and unlikely to occur again. So whenever you have items that fit within those categories, we're excluding them. They're not part of the core business and the core earnings of this company. Changes in accounting principles, we discussed this when we did our ratio analysis. If we have these changes, we just need to make sure that they don't impact our historical analysis of the company. And if we need to undo any of the changes, we will have to. Restructuring and other charges. We just mentioned this for Coca-Cola Amatil, and I'm behind, so I'm not going to stop on this one either. Any changes in estimates? This is a really interesting one, because we get information from management on what is the expected life of an asset, percentage of completion of a development or a building site that they have. Any changes to any of these estimates, expected inflation, retirement benefits, any sort of information that the company is giving us about estimates that would impact the way things are calculated in financial statements. If we see a change in those, we have to make adjustments to them. I will skip a few things as we go along. Now we're on slide 27. Main thing we have to have in mind here is when we're doing the restatement of the financial data, it has to be consistent. That is the one thing that we've been going back to again and again. If we can't go far back enough, we will have an issue. If we can only go back 1 year with an adjustment historically, we will have the issue that ideally we would like to look back 3 years, but within those 3 years, data is not consistent because there were different accounting principles, right? So the question is, do we use 3 years with different accounting principles? Or do we only use the last one because it's the one that is best telling us how the company is going to look in the future? Well, if we can't go back long enough, I would rather stay with the most recent information if that information is more telling about what the company is going to look like in the future. What happens when we are valuing firms across countries? Well, what is suggested here is trying to use this two-step process, which is looking at the firms in each of those two countries, and only after that, look at the strategies of the companies and be able to compare them. Well, this is particularly interesting when you have the same company operating across different markets and you have the company operating in different currencies. So one suggestion here is, if a firm trades debt and equity in the US, but it's somewhere else, then you can reconcile the net income to US to US standards after looking at the financial statements in the company's home currency. So let me, before going to the quizzes, with all these adjustments, all we're doing is getting rid of things that are not portraying information as we think it should be portrayed, that they could be hiding things away or being not persistent and that we will not forecast. And all of these things we're going to do in as much as we can do in a consistent way. If we cannot go far back, we'll stop, right? So we'll go as far back as we can, as long as it's consistent. Let's try. Wow. Yeah. Every now and again, even if it says all of the above, it's not that one. Wow. Be careful. Yeah, so we discussed about going back and redoing the ratios, because those are the ratios that we will use in the future as well. All right, we got a winner. I'm so glad number 12 didn't win, because... Oh, that was you? All right, yeah, thanks for letting me know, yeah. So I'm sorry you didn't win. Who's the winner? All right. I don't think you get to choose. Whatever comes out of here. Oh, you're going to stand up. You got a nice iced coffee as well. All right. Thanks for that. Cheers. Well done. All right. So if you can hold for another 20, 25 minutes, we don't do a break and we just finish early. Does that work, or you rather have a break? Finish early? All right. Yeah, we like that. So there's two sides to these financial statements, quality of financial statements. One is the one we already discussed. Those are things that are more on the side of, we want to get rid of things that are not that telling about the core business of the company in the future, which is what we just did. Now we're moving to another different space, which is earnings management. And the reason for this being different is because these are not actual things happening to the company as we worked with before. These are things that are not necessarily telling us the truth about what's happening in the company. So what's the definition of earnings management? Any decision made by management to disclose information that will mask what's actually happening with the firm. Right? It's hiding what's actually happening with the firm. Sometimes this could be done by adopting standards that apply better to the company situation, but in many cases, it is just hiding information from investors. So what are the reasons why management will try to manage earnings? In slide 33, we have a few reasons for that. Number one is, well, if their remuneration is attached to earnings, they will have an incentive to make earnings look bigger than they are, or to reach certain targets. Job security is also a reason to manipulate earnings. You know that companies doing poorly are usually targets of acquisitions. And if a company gets acquired because it's been doing poorly, the first person to be sacked will be the person making the decisions for the company, which is the management. Another reason would be we are just about to go and get some debt to finance our growth, and things are not looking very good, so we need to make things look better than they really are to have access to that financing. Or, worst case scenario, we already have financing and there's covenants attached to existing financing that say that we have to meet minimum targets. And if we report earnings as we should, we would not be hitting those targets. So there's an incentive to manipulate earnings and meet those minimums. Another reason for trying to manipulate earnings would be to try and have an impact on stock price. And this could be something that is very interesting for management who has been paid with stock options. And at some point in time, they may want to manipulate stock prices and achieve that by manipulating earnings. Another reason could be trying to avoid antitrust. So that would be a reason to try and manipulate earnings downwards and not upwards. So in order to make us not look as profitable, manipulate earnings so that we don't face any antitrust actions. So there's quite a few reasons for manipulating earnings. What are the reasons to not manipulate earnings? Well, one is that in the long term, cash flows and earnings should meet. So it's a short-term game. It's not something that you would be able to manipulate forever. And it's very hard to hide things under the rug for a long time. There's definitely legal consequences and potential penalties. And when you think about it, it's this is a one-way street that once you start doing it, if you can't get out of it, it's really tough. Because if you get fired from a company because it was well known that you were manipulating earnings, it's going to be very hard to go back into a similar position elsewhere. Yes, this is not going to be one of those kind of mistakes that will be kept within closed doors. So everyone will know about this. So you would think that these incentives will make earnings manipulations to be less and less frequent. But when you look at data, you look at over time, restated earnings increase. So so why would a firm restate earnings? Anyone? You want to say it? No? Say that again, sorry. A little bit louder. Okay, so you're saying, oh, they're restating because they want to improve the accuracy of the earnings they're reporting. Is that what you're saying? Kind of. Yeah. Those corrections to earnings could be also because you're trying to give the most up-to-date information to the market so that there's no surprises when earnings are released to the market. This is a very interesting story about backdating options. So remember I was telling you about options given as part of the compensation of management, which is something that is used to align the interest of management to the interest of the shareholders. So there's a study showing that after options were granted, the stock prices would go up, right? Which is, if you're the one holding those call options as management, you'd be very happy if after you got those options, prices go up, because that means you're getting more and more money, right? What they found after looking at many of these companies is, if you look in slide 37, is that what happened is that these options were backdated to say that they were issued at a point in time when the price of the shares was the lowest one. So that way, what they were doing is minimizing the cost of those options to the firm. And they were doing this after the fact that the options were issued. So when this happened, what's happening is that the actual expense of these transactions was much lower than it should have, with the corresponding wealth transfer, because that was not captured in the financial statements. And we have a few cases here that I'm not going to stop to talk about. Enron, that you heard about a few times, WellCome, and a few other things. Let me just, before we finish, so in next week's tutorial, we're going to have a look at a few questions. And I'm going to add a question to our tutorial about a very interesting Australian case of reporting quality and the impact it has on investors. So just a final thought. The reading for this week has a few cases of financial shenanigans, and it's a short reading. I would strongly recommend you having a look at it. And just before we finish, when this reading is discussing financial shenanigans, lists 7 of them, right? So when you go and read it, just keep this in mind. These 7 financial shenanigans are recording revenue too soon, or revenue that is not necessarily going to be made. Number 2 is recording revenue that is not likely to happen. Number 3 is boosting income with one-times, with things that, so number 3 would be making persistent things that are only one-offs. Number 4 is shifting expenses, moving them back or forth. Number 5 is not recording liabilities. Number 6 is moving current revenue to later periods. And number 7 is shifting future expenses to current periods as a special change. So those are different ways in which earnings management could be done, and we have to be very careful not to note this when they're in the financial statements. All right, so that will be it for the presentation. Just give me 2 more minutes of your time by answering these questions, and then you're free to go. You're refusing to participate? Come on. There were call options, not put options. I know this was pure guessing because I didn't tell you about it, but we're going to skip that one too. This one you should know about. So this was clearly the biggest Ponzi scheme ever. Hansa, do you know what a Ponzi scheme is? Yeah? Yeah. All right. So, do you want to tell us what it is?
When you have investors and then you use new investors coming in,
Yeah.
previous ones, so that you got a big return, but
Yeah.
then you didn't generate enough.
Yeah. Yeah, that's exactly what it is. And it's named after an Italian guy named Ponzi, who was the first one on record to do this. But it's basically that, getting new investors to pay the returns for old investors and make everyone think this is a great business. All right. The winner with no team terms, who's that? Is that you? Ah, you got them already. All right. We'll see you next Tuesday. Thank you. Yes. It would be either discounted cash flow or residual income. Yeah, yes, one of those. Cheers.